All right, so welcome back again to building profitable trading systems. So in the last video that I made around identifying your bias and trade directions, we started looking at fundamentals and I talked about interest rates, bond yields, and economic data. So we also went in to talk about indicators. If you remember where I showed off how to use um, something like this envelope, right, to get your buyers. So some people have been asking for more examples, but this is the thing. I'm taking this bit by bit, right? So what we are doing right now is identifying buyers. It's basically just helping you to know, okay, this is the direction I'm supposed to go to. There are several other things that goes into building a profitable system that has not yet been discussed. For instance, after identifying this, what next? There are several other things. They are like 3 to 4 other things that you still need to put into consideration before you get to the final entry. So we're going to be taking it bit by bit. So in this particular set of videos, the last one and this present one, I'm only going to be showing you how to get your bias right. Right. After you've gotten your bias right, you can then go ahead to look for other things. All right. So if you remember, we said when this is above the lower band, right, you want to be buying, and when it is below the upper band, you want to be selling. And you could go on and check to see how that would have worked out in time past. So sometimes you have the situation where you're both buying and selling. That is if you want to use this, right? So when we get into um the next stage, I'm actually going to be sharing an example using this, right? Using how to use this particular stuff to trade. So, but for now, we are going to be moving on so that we don't make this video too long. So what I want to do is to try to keep each of these things to like 30 minutes or less so that we're able to cover a whole lot more within that period. And this is not supposed to be an in-depth teaching. For instance, the FX course is hours upon hours of lessons. It's not something that I can just come and cover in 30 minutes or 1 hour, as the case may be, right? So that is the limitation we have. All right, so let's continue. So today we're going to be looking at market structure and price action. How do you use market structure and price action to get your buyers? So if you are not completely new to trading, one of the things you would have heard is the concept of higher highs and higher lows, right? So you would have heard of something like this. So someone would have told you, if you are looking to buy, what are you looking to do? You are looking for something like this, one price to create this, then give a pullback, right? And then give another leg to the upside. And then we say we have, so this will be a low, a higher low, this will be a high, and a higher high, right? And when we see this, we see this is an uptrend. This is what an uptrend. So you have a low, a higher low, a high, and a higher high. Now, this the first time I heard this, it looked so simple to understand, right? You're basically looking for a higher low and a higher high. Once you see that, you know you're in an uptrend. And if you see the reverse, that is a lower high and a lower low, then you know that you're on what? A downtrend. But when you actually get into the market to look for these things, it is tough to find, right? It becomes very, very difficult. Okay, where is your, where should you use as your high? Where should you use as your low and all that? So one of the things I'm going to be aiming to do, or which is what I've done with the two strategies I usually discuss for those who are new to the channel, which is the fractal OF and the swing shot, is that I've simplified this to like it's so easy, right, to now determine where is your higher high and where is your higher low. So we're going to start with the first one, and that is the fractal OF. So what we're going to do is that we're going to go to TradingView, right? We're going to go to TradingView, and we are going to use our fractals, right? So for me, I am using an indicator called Fractals and Levels by Just Uncle, right? It allows me to just visualize this easily instead of just having the fractals here. It allows it to project a little bit into the future enabling me to visualize it more clearly. Right. So I'm going to squeeze this in a little bit so that we can see how well this has worked in time past. So let's say we start from here in July, right? All we are trying to answer is where did the price break to last? Right? Where did it break and close? We are looking for a close. We are not just looking for a wick, right? So we are looking for the last factor that was broken. If it is this, right, then we assume that we are tilting to the downside. As simple as that. It is literally as simple as that. We have this low broken. That is all we are looking for. We've gotten our lower high. So once we've gotten a lower high, we assume that we are now in a downtrend, right? Until it breaks this one again to the upside, we assume we're in an uptrend. Then it breaks this again back to the downside. We continue our down movement, down movement, down movement, down movement, down movement, and then we break again to the upside. And then we are basically looking for buys, 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 buys. Breaks to the downside, then breaks back during the election. This was basically the the day before the election, and then election day breaks again to the upside, and we are looking for buys, 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 buys until we get another break to the downside. So it's that simple, right? You see, there's no indicator on my charts. I'm just using what price is showing to build my narrative, right? So this is what I mean by using market structure or just price action. You're looking for where was the last fractal point that was created? Has price broken above it? Or where was the last fractal low point that was created? Has price broken below it? Once that has happened, you basically switch your bias to the opposite direction. So price closes below, you are looking to sell. Price closes above, right? You are looking to buy until price does the reverse. And we keep on buying until they give us an indication that they are selling. So that is how you could use that. That is what the fractal OF simply is all about. We are looking for the fractal structure that was broken. All right, we are looking for that fractal structure. We are looking at the fractal structure. Time will permit me to go into the whole thing around the fractals, how they are formed, why they are so important, and all that. That is something I take time to teach about in the FX because a little bit, because it's important to understand that. But you could actually go on YouTube and search more about fractals. I will encourage you to actually look for the real person that started, which was Bill Williams, and study his concept around chaos theory, right? Because that's what the fractals were based around. So you need to, if you want to really go into depth studying that, it's not important, right? What I'm presenting you with here is what you need to actually put it to use. It's not so important that you learn all the theory behind it, right? So once we get a break, then we are buying. If we get a break to the downside, we are selling. As simple as that. Now, the second one I'm going to be talking about again is the swing shot. So you could do this on both the USD basket and the dollar futures, as I mentioned, but I found this to be more accurate using the USD basket, and that is because the USD basket basically is an equally weighted um, how do they say it again? So let me just push this way. So USD versus equally weighted basket of Euro, GBP, JPY, CAD, and AUD. These are like the five biggest currencies, right? The world. So if you check the USD against it, now one of the things with the dollar futures is that it's not equally weighted. The euro has, I think, close to about either 50 something or 60 something percent. That is why you see that the USD futures is so correlated to the EU, right? So correlated with EU, and then to a lesser extent GBP USD as well. So it is the USD futures is not equally weighted. So what this equally weighted basket does is that it actually gives me a clearer picture of how strong USD really is against its peers, right? Without being biased to one side. The USD futures is kind of biased towards the Eurozone, right? Whereas the USD basket is more balanced out, right? So That's by using the two of them, I'm able to get a clearer picture of what price is doing. So you will see that I use both the factor OF, USD futures, and then I use swing shot on the USD basket. So two of them together are able to give me a picture that one by itself is not able to give me standing alone. All right, so let's get into how we'll do that. So we'll go to the weekly. All right. So a lot of the confusions that we usually have stem from the fact that we are usually looking at price from the lower time frames, right? Just pardon me, I have a little bit of cold. All right, so if we then look at this from a weekly perspective, remember what we are looking at for. We want to see higher lows, higher highs, higher lows. This is slightly higher, this candle. We can look at it from the data window, right? Let's look at the lows. This one is 1200.31. This is 1200.33. So this is slightly higher, right? So higher highs, we are comparing the lows and the highs of 2 weeks. All right. So we look at this, higher lows, higher highs. So what are we expected to do on this week? We are going to be looking to do what? We are going to be looking to go up. All right. It's really that simple. Again, we'll compare these 2 weeks. So when this week is starting, we compare these 2 weeks, and what do we see? Higher lows, higher highs. So we are looking towards buy. Again, we just continue doing that. Higher lows, higher highs, buy. Higher lows, higher highs, we are buying. Higher lows, higher highs, we are buying. Then this becomes a sort of indecision. Why? We have taken out both the highs and the lows. So where should we be going to? Right. So we have what we call inconclusive. Now for the swing shot, I also look at the close, because I discovered that just looking at the highs and the lows, why that is good on its own, it doesn't give the whole complete picture. We have to look at how it's closed, so that if we have a rejection candle, right, just imagine that this kind of candle closes. Will you really see that this is because it created higher highs and higher lows, that this is bullish, right? We need to look at such things before we conclude on what price is doing. So I like to see, you might incorporate, say that I want to see a close above the previous week's close for it to be a valid trade, right? So this is valid, higher high, higher close, higher low, and then a bullish close. Higher high, higher low, 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 bullish close. Now this is indecision, and you can decide to sit out this week. And then higher high, higher lows, bullish close, you are buying again. So this week again, now this week will be a bit of indecision, because why? We did not get a close above this. Now, for me, that is not really how I do my close. How I actually do my close is that I take a fib, right, and I drag it from the low. So you'd have been wondering, but I said this week is bullish or swing short. Okay, so I'll explain how to do that. Or rather, sorry, I'm supposed to drag this from the lows to the highs. All right. So higher high, higher low, yes. And then I fib the whole range of the candle, and I want this to close above my 40%. Right. I want it to close above 40% of that range. Right. If I'm bearish, I want it to close below 60% of the range. Right. So I want it to be more than half of the range. I want the close to be at the upper end of the candle's range. And if I'm bearish, I want the close to be at the lower end of the candle range. So let's assume and pick one that is not only just pick one. All right, so something like this. All right, so let me pick this. Okay, I think this is more of an indecision candle, right? So price created lower highs, lower lows. So do we have a bearish close? We will flip this. And no, it didn't close bearish, right? It didn't close bearish. So this would have been an indecision week for us. Now, by now, you would have seen some of the pros and the cons of all this, right? The first one is that when you're using price action, um, you will always have that issue that when price is changing, like when the trend is changing, you're going to take a couple of losses. So let's assume right here, right, would have seen lower highs, lower lows, right? So when the trend is about to change on this week, you would have taken some losses, right? You would have taken some losses, right? Here again, we are bullish here. When it's about to change, you would have taken some losses. You might have been bullish here. When it's about to change, you also take some losses. So it doesn't matter whichever way you're deciding to do it, whether you're using indicators, whether you're using price action, when the trend is changing, you're going to take a couple of losses. That is why we always use risk management. That's why risk management is so important, so crucial. Now, whenever you are using um, technical analysis, there is the issue of time frames. So if you go to one time frame, you go from one time frame to another, there's the possibility, if you're not careful, that you see different, what you see is different. This is especially very common with indicators, where you're using indicators, and then some indicators that's where you have to use settings. All right. If you change the settings, what you're seeing might actually be different from what another person will see. Now, that limitation is less when you're using price action techniques, market structure, and all that. If you know how to read it properly, what you're seeing on even the lower time frame, if you really know what you're doing, will be the same as what you're seeing on the higher time frame. But I just need to mention there is always hierarchy of time frames when you're using technical analysis. So the higher the time frame, the more important the data that you are getting from it. I don't want to go into all the other blogs and all that and all that. It's going to just open up a whole different can of stuff. But at the end of the day, basically in market structure, you are looking for higher highs, higher lows when you want to buy. You are looking for lower highs, lower lows when you want to sell. Basically, that's what you are looking for. You are looking for a break of structure to one side to want to go in that direction, or a break of structure to the other side to go in the opposite direction, so that we don't keep this too long. So we are going to go into sentiment. Sentiment. Now, when it comes to sentiment, we are going to be looking at two things. The first one is the risk sentiment, and then the second one is the positioning. Positioning, and then um, first one with regards to risk sentiment is what we call risk on and risk off. So in the market, you might have heard of risk on, risk off. What is risk on? What is risk off? So risk on occurs when traders are um, more bullish on riskier assets. So there are assets that are more risky, like commodities, like your cryptos, like your stocks, and all those things are not so safe compared to things like bonds, right, and treasury bills and all that. So once there is risk on in the market, traders are willing to take more risk. They are willing to be more adventurous. So what do? They swim into commodities and all that. Now, there are certain currencies that are suited to certain types of environments more than others. For instance, when there is a risk of, we have what we call safe haven flows. So there are currencies that are considered to be very, very safe. And once traders are fearful, once the market is scared that maybe something is going to happen, maybe a recession, maybe breakout of wars, pandemics, all that, they usually pile into certain um, currencies. And those currencies are your USD, your JPY, and your CHF. Your USD, your JPY, and your CHF, right? Swiss franc. So those are the three risk off currencies. They are the safe haven currencies. So once people are scared something is coming down the line, what do? They move most of their money to Switzerland. They move most of their money to Japan or into JPY, or they move most of their money into USD, right? And as well, they begin to buy a whole lot of bonds. And as they buy such bonds, they are moving money away from stocks into those bonds. So that is what we have with risk sentiment. And then risk off, we have the currencies that are more aligned with risk off, like your AUD, your NZD, and your CAD. CAD because of crude oil and because of how closely correlated it is with crude oil. So those are your risk off currencies. So one of the things that I do is I created a barometer for measuring my risk on and risk off. So what I basically did was to come to TradingView. It's something you can actually do and add your risk currencies together, right? You add your risk currencies together. So your AUD futures, NZD, and CAD. So if you add those things together, all you need to do is I think I showed in the last video how to use this. You just come here, 6A plus 6A1, this plus this, and then you basically get this, right? So once you have been able to get this, we are then just going to be using factor OF to determine whether we are bullish or we are bearish. So on the 7th of October, the risk sentiment turned bearish, right, generally. So what you'd have seen is that remember I said that what I'm doing is largely focused on currencies. It's largely focused on currencies. So you would have seen that your AUDs, the NZDs, the cards started going down, right? And your GPYs have been a little bit strong or ranging, right? So once you see this happening in the market, you know that we are largely in a risk of environment. We are largely in a risk of environment. Recently, it has not been so correlated with stocks and crypto, and that is because of basically Trump. Right. So you need to always understand it doesn't mean that it's now wrong. You don't throw it out of the window and say it doesn't work again. For this, you need to understand when the thing might not work so well and the reasons why it might fail when it does fail. So that is basically that about the risk of sentiment. So if you are someone that trades a whole lot of AUD, NZD, and CAD, then you basically want to be aware of this as well as trading JPY and CHF. So the inverse is the case. So as this is bearish, it basically means that your JPY is likely going to be a bit bullish, right, or ranging. And your CHF is also likely going to be bullish or ranging against this commodity pairs as well. So just to do a quick one, we are going to look at this. So this broke to the downside 7th of October. So what we are going to do is that we're going to load up something like AUD JPY. AUD JPY, and we are just going to click on this. We are going to see what happened. So 7th of October, we are here. All right, so broke to the downside 7th of October. And basically, we've been bearish, we've been ranging ever since. Now we are breaking out to the downside, right? We're now seeing the break to the downside. So that is, so all while you are here, if you understood your risk sentiment, all you have been doing is building up positions to sell, right? So here you would have been looking for opportunities to sell, even here. You won't have been really considering this factor OF. You have really paid attention. If you are considering it, you would have still had at the back of your mind that we are bearish. And then, of course, when the fractal OF eventually aligns here, right here, you'll be looking for reasons to sell. And now it looks like we are getting a break out of this range, this whole consolidation, which you would have seen if we were using the risk sentiment, right? If we go back to even much earlier in the year, So we can see that from or before then here on the 16th of July, we turned bearish, right? Note that. And then 8th of August, we turned bullish. So let's go back to our AUD JPY. Sorry, this is going to take a bit of it a while. Just doing this for those who ask for more examples. So this is 16th of July. We turned bearish. So you could see that whole strong move to the downside. And then 8th of August, we turned bullish. And of course, from then on, you should have been positioning yourself bullish. So even when all the sell-off was happening, you would have known at the back of your mind, we're still going up, right? We're still going to be going up and all that until later in October, I think 8th of October, so we turned bearish again. So that is basically how you could use the risk sentiment. You could go ahead and play around with that and see how that works out. All right, but the main thing I really want to discuss when it comes to risk sentiment is positioning. Positioning. So basically, there are two things that you want to consider whenever you are doing this. The first one is the positioning of retail, and then the positioning of your big guys, that is using the COT data. So to get the retail positioning, we're simply going to go to my FX book. Somehow I didn't load that. All right, so we are going to go to my FX book, the economic calendar. All right, so if we go to every week on Mondays, you get to see how people are positioned, right? So let's start from this. So AUD, previous was 89%. Now about 80% of those who have accounts on TradingView, real accounts, are 80% long. They're 80% long on AUD, 30% long on JPY, meaning they are 70% short, right? So imagine what is happening now on AUD, JPY. People are getting wiped, like seriously wiped. All right, so Euro, 76% are long, right? If you go to GBP, 81% is long in the market, right? So if you've listened to my market preview for this week, you know that we actually short Euro and GBP, but you can see that a majority of retail is what they're long. And then the final one is CAD. You could see that just 9% are 9% are long, so 91% are short CAD, right? So we will continue keeping an eye on this and watch how that plays out. But basically, if we assume that the data that we get or the statistics that we get that retail traders are wrong more than a whole lot of the time, so more than 80% of the time that retail is wrong, then you know how you can use this data to your advantage. So that is what we are looking at when we look at sentiment. We are simply looking at the positioning of different players in the market. The next thing I'm going to talk about is the commitment of traders report. The commitment of traders report. So to do this, you just need to come to this chart. This chart. Why this keeps doing this. All right, so I like to use the futures. You could also use this one that shows the this is free, by the way. You could actually get this for free. I'm not paying for it. So you could come here and see what the net change is for the week. Right. So this data is usually released on Friday. So by Saturday, you could just come and check it out. And it shows you what the net change was for the week, right? So you could see that people, the This is for non-commercials. These are the large speculators. Those are the people that the traditional way people do this. These are the people that you are supposed to be watching. So the net change, they added some positions to this. If you look at euro dollar, a whole lot of negative. So before the net positions were already negative, and now they added more. They added more to it, right? They added more to it. They added more to their net negatives that they had here. So they closed some shorts, some long positions rather. They closed some of their long positions and then added some shorts. Yet a whole lot of retail are doing what? Are doing the opposite. So that is one of the ways to get this. You're just looking at what happened week by week. Now, when this data is released on Friday, it only covers what has happened up to Tuesday. So that's the limitation, but we'll still talk about that later. And the next thing you can do is to come here to this futures commitment of traders. So you can get it by looking here. If you look at commitment of traders and you just open this, then you will get to see it. So for me, because I'm basically trading the USD, this is what I am always very much interested in. So the US dollar index. So once we open up that, and we come here, we get to see this report. So we can change this from bar chart to candlesticks, open to close. So it looks like what we normally have. All right. Now, my own preferred way of doing this is to sum up all the positions. So there are two groups of people that you are looking at. The first one is the commitment of traders report, and then the next one is the commitment of traders financial traders report. So what I normally do is, so usually what they would have told us is you need to see them decreasing their positions. So you could see from the peak where we had here, we are looking at the green line, which are the non-commercials. All right, so you can see the non-commercials or speculators consist of managed money and other reportables. Those are your big banks, your hedge funds, and all that. So the moment they begin to reduce their positions, the market can still push up for a little bit, but eventually it begins to drop and drop and drop and drop. But then you can see places like this where it seems that they are reducing their positions, but price is still going up. So what is happening, right? That is where that approach is not very, very correct. The best approach is to come here and sum up your a better way would be to sum up all the positions that you actually have here, right? You sum up everything. So let's look at this period, for instance. All right, so the last reporting was right here. So if we are to take the net position of what we have there, right, we'll then be able to get a more accurate picture of what exactly is going on in the market compared to the previous. So you're going to sum up what is here, and then you're going to sum up what is here, and then compare it to see did it increase or did it reduce? Because different people are doing different things in the market, right? So your commercials are basically people who are they are not really interested in where the price is going to. So they are producers or they are merchants who are basically trying to hedge their own risk. For instance, let's assume that Apple needs to pay people that are in the Eurozone, right? And uh, they don't want a situation where maybe I've budgeted $1 billion for that, and then maybe euro appreciates so much against the USD, then the $1 billion they had initially is no longer enough. So what do they need to do? They need to open up a position. all right, that enables them to cover for that risk so that even if that happens, they would have made some money from that angle to offset the loss in value for their the money they had earmarked. That is just using a very, very crude example to illustrate how that works. Also, the other people you have there is processors, all right, people who process transactions and all that. So those ones too are not interested. They're on it. You say you want to buy at two cents per price. All right, so we'll get you we'll do the exchange, we'll facilitate the exchange for you and all that. So all those kind of people are different. Their role in the market is different, right? So the other one you need to be aware of is the commercials. So basically, what the commercials or the non-commercials are doing, and those are the people who actually want to make money from how the price is going. So that is why traditionally they are the people to be watched out for because they are the ones who are trying to make money in the market. However, if the other players outweigh them or outnumber them, what will basically happen is it's still at the end of the day, it's still a zero-sum game. It's still a zero-sum game where it is the volumes, where volumes are moving to, or how the volumes are in the market that determines what happens. So if the buyers outnumber the sellers by far, price is going to go up. And if the sellers outnumber the buyers by far, price is going to do what? Go down. If the sellers outnumber the buyers or the volume of selling outweighs the volume of buying, right? Price is going to go down. So what you need to do is to find what is the sum total of all these positions. So let's do a quick one, right? So we have this. All right. So let's do this. So we are going to sum up this week first. So we are going to call this week one, and then we'll call this week two. So let's go. So from commercials, we have 1 1, and then we have minus 2 3 1 2. So let's include that. So we have 1 1, and then we have minus 2 3 1 2. Right. The next one we have there is 1 2 1 2. 1 2 1 2. All right. So let's continue. So we've now gotten the first set. So let's move on to the second set. So we have 3 1 7 6 and then 11 3 7 3. 3 1 7 6. Trying to do this in real time so that you can see how that is done. 11 3 7 3. 11 3 7 3 and minus 15 minus 15 607 607. So we can then sum that up. Right, and we get this negative number as our total. All right, so let's do this again for the current week or for last week. Right, so what we have is 1921 and then minus 2713. 1921 minus 2793. 2713, I'll change that, and then 792. 713 and then 792. All right, so let's look at the next set of people. We have 3287 and 13186. 3287, 3287, 3287, 13186. And then minus 17130. Minus 17130. Okay, so what can you see? So you can see that the negative has reduced. All right, more longs are coming into the market than shorts. Right, so that is what you want to be watching out for. So that can tell you that for this week, all right, for the current week in question, which is right here, that your anticipated move is what? To go up. So you can go ahead and play around with this, right, and see whether what I said, how true it is or not. All right, using the COT data, using the COT data. So I'm sure that is different from what you've heard in time past about just using commercials or non-commercials or looking when they are wide at extremes. The issue is, when are they really at extremes? How do you know that the extreme cannot get more extreme and all that? This is, I suggest to you, this is a better way to go about doing that. So you sum up all the whole totals, check it week by week, and then you get a good idea of what you should be doing for the week in question. So we can see that the negative is reducing. So that is positive for the USD, right? That is positive for the USD. So when this will really kick off is when this now turns fully positive. Then we'll get a whole lot of movement to the upside, right? So that is how you can use this. Again, the limitation with this is that you are basically watching what happened from all the data we have that was released on Friday, was basically what happened up until Tuesday last week. So we don't know what happened Wednesday, Thursday, Friday. We don't even know what is happening now on Monday, Tuesday. I'm recording this video on Wednesday. So Wednesday morning. I don't know. You don't know what has happened between then and now, right? So these are the things that you need to be aware of. You need to be very much aware of. So that is the limitation. So one of the things that I did, and I have now taught them, in fact, that forms a whole lot the background or the foundation to a whole lot of the models that we use in the FXP course, is that we've created a way to track this in real time. We've created a way to track this in real time right on TradingView. So it's not even, your MT4 doesn't have to be open all the time. It's something you can do right on TradingView and all that. So we're able to track what is happening with volume in real time. Now, again, the limitations, as with every other thing, just like your COT, everything, is that when there's going to be a change in trend, there is likely the possibility that you're going to take a couple of losses. So if you watched videos maybe in the last 2 weeks, you'll see we're actually bearish on USD volume wise. And when you actually sum this up, you will come to understand a little bit why, right? But we are beginning to see that has now changed. We are now bullish. We've turned back bullish on the USD again. So I've taken time to walk us through the whole sentiment. We started, remember where we started from? We started looking at fundamentals, we looked at technicals, and then we now looked at sentiment. So two ways that I encourage you to really use sentiment. One is to just simply go against retail. So if retail is going one way, you want to go the opposite direction, right? Occasionally they'll be correct. Occasionally they will be correct, because even a broken clock is right twice a day. So occasionally they'll be correct. But if you just stick to going against what the retail traders are doing, then you are going to be on the right side of the market majority of the time. Again, you can use your COT to also join, track the volume in the market and join whatever they are doing. Now, so that is that. There's no, I'm not saying you must join the FXP, but of course, if you join the FXP, you're able to know how to get your volume trend much easier, make your whole tracking easier as well. And of course, you could use the Black Friday code Black Friday to get 30% off your membership fees is once for all, and then get lifetime access to the videos and every other thing that comes with it. Of course, did you know that those who were in the FXP actually got the trend engine for free? Yeah, they actually got the trend engine for free. So they didn't have to pay anything for a 1-year license to the trend engine. That offer has passed now anyway, but of course, they always get preferential treatments when it comes to any of the products that I release in future. So that will be that. And the next lesson will then begin to answer the question, where or when, right? Where. So we now know the direction we should be going. At what point should we get in, right? So how do we now take advantage of our direction? And with that, I'll be going into the two different methods that virtually every trader uses, right? There are two methods that every trader uses to get in. So you want to know what those two methods are? Join me in the next video part as we begin to explore that as well. So in that video, in the next video, I'm going to be sharing with you the secret sauce or the secret ways that will explain some of the things that you've heard so much in the market that you just don't really understand why people use them and all that. But by the time we finish going through that lesson, you will gain much clarity as to why those things are the way they are in the market. So join me in the next video, which will be coming out again next week, and we'll take it up from there.